Hey everyone, and welcome back to the channel. Today, we're diving deep into one of the most talked about, most powerful, and frankly, most dangerous tools in the entire crypto space: leverage. If you've ever dreamed of turning a small amount of capital into a significant position, then you've probably heard of it. But here's the deal. Used correctly, leverage can be a rocket ship for your portfolio. Used poorly, it's a one-way ticket to getting wrecked. So, stick around, because by the end of this video, you'll understand how to handle this double-edged sword like a pro. First, let's break down what leverage actually is in simple terms. Imagine you want to buy a whole Bitcoin, but you only have a fraction of its price in your account. Leverage is what bridges that gap. It lets you borrow capital from the exchange to control a much larger position than your own money would allow. For example, if you have $100 and you use 10x leverage, you are now controlling a $1,000 position. It sounds amazing, right? A tiny 1% move in the price of the crypto you're trading doesn't just mean a 1% gain on your 100. Because you are controlling a $1,000 position, that 1% move translates to a 10% gain on your initial capital. Your $100 just became $110. That's the magic of leverage. It amplifies your results. But, and this is the most important but you'll hear today, it amplifies everything. That includes your losses. The hidden danger of leverage is that it magnifies risk just as much as it magnifies gains. Using that same 10x leverage example, if the price moves just 1% against you, you don't lose 1%. You lose 10% of your starting capital. A 10% move against you? Your entire $100 is gone. Wiped out. This is called liquidation. The exchange automatically closes your position to cover the loan, and your margin, your initial investment, disappears. The higher the leverage you use, the smaller the price movement needed to liquidate you. At 20x leverage, a 5% move against you is all it takes. At 100x leverage, a mere 1% wiggle in the wrong direction, and it's game over. There's almost no breathing room. That's why so many new traders get wiped out. They see the potential for massive gains and completely ignore the cliff edge they're standing on. So how do the smart traders, the ones who are consistently profitable, use leverage without blowing up their accounts? It all comes down to a set of principles, a mindset shift away from gambling and towards strategic risk management. The first and most critical principle is to never, ever go all in on a single position. Opening a trade with 100% of your portfolio is financial suicide. Instead, smart traders spread their capital across multiple orders at different price levels. Think of it like setting a net, not throwing a single spear. When the price moves 1% against other traders, they're sweating, panicking. But you're actually hoping the price drops a bit more, because it means your lower-priced buy orders will get filled. This gives you a much better average entry price for your overall position. A better position means a lower liquidation price and a higher potential for gains when the market turns. Next, you need a serious perspective check. The goal in crypto trading isn't to become a multi-trillionaire overnight. That's lottery ticket thinking. Remember, traditional banks might offer you a 3% return on your investment per year. In crypto, if you can make 5% on your capital in just a couple of days using a well-managed, leveraged position, that is a monumental success. It's all about perspective. Don't compare your journey to the one-in-a-million story you saw on social media. Compare it to realistic, sustainable financial growth. We all want to be that trader with a perfect track record, no losses, only wins, but that person doesn't exist. The difference between a successful trader and a failed one isn't the absence of losses, it's the patience and discipline to manage risk properly so that the wins far outweigh the losses. So, train yourself to be patient. Wait for the right setup. Wait for your price targets. The market will always be there tomorrow. Your capital might not be if you're reckless. Now let's get into some more advanced tactics. One powerful tool is the liquidation map, or heat map. These tools show you where large clusters of leveraged positions, especially short positions, are set to be liquidated. Why is this useful? because large market players, often called whales, can see these maps too. They know that if they can push the price to a certain level, it will trigger a cascade of liquidations, which forces a rapid price spike, a short squeeze. By identifying where these liquidation zones are, you can anticipate these powerful moves. However, a huge word of caution here. Only use liquidation heat maps for Bitcoin pairs. And always combine them with volume analysis. On smaller altcoins, these maps are often misleading. Whales can easily manipulate the price of low-cap coins and use the appearance of a liquidation cluster to trap retail traders like you. Don't fall for it. Stick to the deep liquidity of Bitcoin, where the data is more reliable. Another trap to avoid is relying solely on technical analysis. All those patterns, head and shoulders, double bottoms, trend lines, do you really think the big money players don't know them? They do, and they use your reliance on them to their advantage. They will paint a perfect bullish pattern on the chart, wait for everyone to jump in, and then dump the price to liquidate all those hopeful long positions. Technical analysis can be a piece of the puzzle, but it should never be the whole picture. Relying on it by itself is like getting ready to throw your money into a bin. You have to think bigger. Here's a rule that has served me well. Focus primarily on long positions. Going long means you're betting on the price to go up. Shorting, or betting on the price to go down, is an incredibly dangerous game in crypto. The market has a natural upward bias over the long term, and news or data can change in an instant, sending a price that was falling into a massive rally, liquidating all the short sellers in its path. As a general rule, it's much safer to swim with the current than against it. Avoid shorting unless you are an extremely experienced trader, and while you're at it, stop chasing the perfect entry. It doesn't exist. You will never perfectly time the bottom. Instead of obsessing over the perfect entry, focus on perfect risk management. Your entry can be mediocre, but if your risk is managed perfectly, you'll still come out on top. This brings me to a controversial point. Risk management is better than a traditional stop loss. Think about it. When you set a tight stop loss, you're essentially telling the market, here, right at this price, is my pain point. Please come and take my money. And what happens? The price often wicks down, hits your stop loss, takes you out of your position, and then immediately reverses back up. You were right about the direction, but you still lost money. It's called a stop-loss hunt. Instead of giving your money away, your goal is to take their money. Proper risk management, using smaller position sizes, averaging into your position, and having a deep understanding of your liquidation price, is your true defense. Another little tip. When you do open long positions, try to do so when the funding rate is positive. A positive funding rate means that traders in long positions are paying traders in short positions. This suggests a bullish sentiment. But be careful. If the funding rate is extremely high, it could be a bait set by whales to lure in late longs, just before a price drop. Always be critical. Finally, one of the best things you can do for your trading and your sanity is to use trading bots. What's the point of being in crypto if you're chained to your screen 24/7? That's not freedom. Staring at charts all day makes you emotional, and emotional trading is losing trading. Your risk management goes out the window, you start revenge trading, and at the end of the week you're looking at a sea of red wondering, why did I do that? A good grid bot or DCA bot can execute your strategy for you, buying the dips and taking profit automatically while you're out living your life. You have a life, so go enjoy it. Let's wrap this up. Leverage is not a get-rich-quick scheme. It is a professional tool for amplifying well-thought-out strategies. The secret isn't finding a magic indicator or a 200x leverage play. The secret is mastering risk. Once you learn to protect your capital and manage your psychology, the gains will naturally follow. Thanks so much for watching. I hope this gives you a much clearer, safer framework for thinking about leverage. If you found this helpful, do me a favor and hit that like button. And if you want more content to help you navigate the world of crypto safely and profitably, make sure to subscribe and turn on notifications. Stay safe, trade smart, and I'll see you in the next video.